Welcome to the Foundry, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today we have Clive Davis, founder of Park Royal Capital. Welcome to the show, Clive.
Thanks for having me, George. Appreciate it.
Wonderful. Well, I'd like to get us started just by asking you the standard question about sort of who is Clive Davis and how did you find your way into becoming a full-time real estate investor?
Sure. So Clive Davis is the father of 4 children, ranging in age from 11 to 22, married to a beautiful wife who I met at college at my alma mater, Rutgers University, back in the early 90s. So that's the immediate family. On the professional front, I have quite a varied pathway to what I'm doing today, which really starts with me being a corporate transactional lawyer on Wall Street. That's where I cut my teeth out of law school and did that for a number of years before transitioning in-house as in-house counsel, initially for Pfizer, worked for them for a number of years. They actually relocated me to Atlanta. I then went on to be a chief compliance officer for a Belgian biopharma. So all in all, I had a 20-year corporate career. Throughout most of that career, I was invested in real estate in a very small scale. And I would say not so much in a professional way. It was probably more hobby-like in terms of my reliance on those funds. It was always peripheral to my 9-to-5, which was the primary gig that paid the bills. And so my very first investment in real estate was a duplex property down in Cape Coral, Florida, which is Southwest Florida, probably about 2+ hours northwest from Miami. So I did that from New York. I self-managed it. I had always self-managed my small real estate holdings. 20-year career. At the end of 2016 is when I made the bold decision to walk away from corporate America, take a leap of faith and pursue real estate investment full time, and really focused on multifamily, and specifically large scale multifamily of the type that I'm doing today. So that's a quick overview of the background and what brings me to where I sit today.
Excellent. And we do like to focus on real estate here. So maybe we could dig in just a little deeper. Tell us, what is your investment thesis? What sort of large multifamily are you looking for these days?
Yeah, so it's interesting to see how my criteria has evolved and continues to evolve. But I would say today, my primary focus in terms of properties that I'm looking to get under contract and ultimately close are value add properties. They tend to be B class, preferably B to A class, are properties that I'm offering on 1980s or newer. Ideally, the newer the better. So the first property that I acquired, large scale property that I acquired, it is the C-class property, 1970s vintage. And so that was acquired back in November of 21. So you can see just in the 7 or 8 months, my criteria has evolved to the point where I would likely not look at anything that was older than 1980s and probably would be biased towards B class and better. And the thesis, basically, any value add thesis is that we are going to find underperforming properties that have not been invested in for whatever reason by the current ownership. And we are going to unlock and release value through our efforts to improve the units, improve the amenities, and in doing so, derive value that hasn't yet been unlocked by prior ownership.
Excellent. I love how you took us through your evolution as a commercial real estate investor. I think that is generally how things work. People do start out with the harder lifts. They're looking to make a lot of money on those earlier properties. And as they get more experienced, you get to learn how to run things. And obviously, you were a leader in your former life. But now, as you are experienced running properties, you can find a lot of operational inefficiencies, properties, as you said, that are maybe not optimally run, and that's great. So exciting. And I have to say, from the time frame you're mentioning, I think you said your first, I'm sorry, you had that C class that was it 2019 that you mentioned?
2021, actually. So
2021. Okay, I see.
In the summer of 21, we ultimately closed it in November of 21. The very first property, the one thing I tell people is I'm not an overnight success in what I'm doing today, because I submitted my first LOI back in April of 2019. That was my first. It was a 92 unit, if I recall correctly, here in Atlanta. And we were runners up. We were the two top groups, and we ultimately didn't get it. And so that was my first LOI. I said, no problem. Didn't get that one. I'll get the next one next month. And fast forward, it ultimately took me an additional 2 years. Now, obviously, COVID was in that window, and that kind of frustrated efforts to some extent. But nonetheless, it took me the better part of 2 years before I landed that first big deal, 244 units that we acquired for just under 30 million.
Exciting. Yes, because I was going to ask you about that pandemic timeframe. I know that's when the A and B properties, oh my goodness, did they ever do so much better than C class, far out past the C class. But I'd have to say, even since that pandemic timeframe, A and B, as I remember, continue to outperform. I wonder, do you have a thesis as to whether that's going to continue or not?
Well, I think the C-class properties, as it relates to just general times, normal times, but certainly true during COVID, they were just more susceptible to higher delinquency rates.
Right.
You're dealing with kind of the blue collar working class on the lower end of the demographics, income earnings wise. And so they're going to be more susceptible to kind of something like, the black swan that is or was COVID.
Watch out for monkeypox.
Yeah, well, that's another thing to keep our eye on. But the B and A class properties tend to be the folks who were easily transitioned to work from home, remote opportunity.
Right.
They're not in the service sector. They're not having to show up to the same extent that C-class residents are. So from that standpoint, C-class was just, again, susceptible to some challenges that you weren't going to see to the same extent in the B-class and A-class properties. But going forward and in normal times, one thing that we've seen, and I'll be interested to see whether or not this changes, but one of the things that we've seen over the last few years is that the differential between C, B, and A class properties from a cap rate standpoint has narrowed. So that once upon a time, I'm making these numbers up, but let's say that an A class was going to be a 3 cap. You might say B class was going to be 3.25 to 3.5, and your C class might be 3.75 to 4. That differential just kind of condensed or collapsed. And so that's why you started seeing people look up the food chain and say, look, if I'm going to be paying 3.5% for a C class property, I might as well go get me a B or an A for not that much more. So I don't think that's a long-term thing. I think that's something that's going to unwind itself. But for now, there's good reason to be eyeing upper class, so to speak, properties if you can get them and if there's sufficient inventory in the markets that you're in.
Yeah, I mean, I love it. I love the analysis too, that that compression between your A and your C definitely does make the A and Bs make a whole lot more sense. I'm concerned myself, though, about affordability, and I wonder if the A's and B's are going to be able to continue their great run. And also, there's the issue of cap rate expansion, which I don't think that we've seen in any way or in any markets that I'm aware of yet, but it's something that's certainly expected. We're going to have to figure out what happens next, right? Does the Fed reverse course, or do we see this long expected expansion? We shall see.
Yeah, I'm not an economist, but I listen to a few and I follow a few, and as best as I can tell, and if you look back at history is always a good guide as to what might be coming ahead of us. Although we'll probably get a 75 basis points increase. I think tomorrow is when the Fed is meeting, and probably another 50 or 75 the meeting thereafter. I think we're already on the clock for when interest rates will be coming down. And so retreating and unwinding some of the activity that's happening now. And so from what I understand, by late 23, if not early 24 Q1, we're already going to see rates coming back down. So I think we're in a window where there's a real opportunity. If you recognize that, look, I'm getting this property cheaper than I could have gotten it 6 months ago, primarily because of what's happening in the interest rate environment. And you know that interest rates are going to be retreating in 18 months or less. Then you've got, if you can kind of get in with the right numbers and the deal pencils, then just some macroeconomic things outside of your control are going to contribute to increased value in anything that you're able to acquire over the next, I would say, 6 months plus. So,
yeah, great to remember. I mean, although we are basically as low as we can get without negative interest rates, we don't really know where things will be in a couple of years. And I think that maybe some of the greatest doomsayers probably need to calm down a little bit. At least, I'm not saying that the Fed heads and governors and other important talking heads out there haven't gotten it really wrong in recent history, but they are all saying that things are going to have to come down. Yeah, unless we think that they're really going to go the inflation hawk path, which I have a hard time. I was a little kid last time the Fed went inflation hawk.
yeah. It's been a while.
So anyway, probably enough on the topic of macroeconomics. What I'd probably like to do is maybe have a soft transition out of there. How has the recent higher rate environment influenced your plans and execution? Are you doing anything differently these days in terms of, how you're closing deals or what sort of deals you're looking for? Because we do know that obviously you're going to close in a higher rate environment, and of course, anybody's guess what it's going to be 1 or 2 years down the road.
Yeah, so I would say it hasn't really changed kind of the type of property that I'm looking at, interested in, and pursuing. The biggest impact is the way that I'm underwriting today has to factor in not only where we are from a rate standpoint today, but where we likely will be in the next 6, 12 plus months. And so therefore, I'm now incorporating interest reserves into my underwriting. So I'm raising with that in mind, that I've got to be responsible to my investors and ensure that I'm not asleep at the switch, and we've kind of factored in kind of the macro economy that we've just been talking about. So I know availability of loan products has changed dramatically. And, we closed another property in February of this year, 200 unit, $40 million deal. And the loan options that were available to us then are not necessarily available to us today. And that's being driven by what's going on again with interest rates. And so whereas, the bridge with the exit being refinanced into agency debt, if not an outright sale, was kind of the basic model. Now we're having to reconsider our hold time as well as our exit plan. And so we don't go into any deal without an exit strategy. So now there, you've got to rethink what kind of loan to value is going to be available to me when I do want to refinance. So that's one thing. What are interest rates likely to be, when I do want to refinance? And so I would say that when you're modeling in that refinance, we're probably more conservative today than we would have been on a deal 6 months, 12 months ago. And these are questions that your investors are going to ask of you when you're presenting them an opportunity. So you better have good answers, and you better have thought through, not only how do we get into the deal, but how do we get out? And, what's the potential impact on the returns that you are promising to your investors? So same deals, but giving a lot more thought to the underwriting, and probably being more conservative than I have been in the past, just because when there's increased uncertainty, that there's even more reason for you to be conservative, because that crystal ball is a little bit foggy.
Love it. All great points. Definitely changes the underwriting. change the sorts of debt that makes sense. I really love seller financing. That's not something you can really do with those very large properties. But I've been pushed in a different direction by the macro environment. I've looked at smaller things, just love it when I can get a seller finance. And you mentioned reserves too. A great thing to have. And I think these are all questions that certainly every operator should be ready to answer. And if not offered, then I would say, you passive investors out there, I would say definitely these are questions you want to ask.
Absolutely. I mean, I'm a passive, as well as my active deals that I'm on and involved with. I am a passive investor too. And so I think in the last 3 weeks, I've passively invested in 600 units. And so across 2 deals out of Houston. And so, obviously these are questions that I'm asking and other passive investors are asking to get comfortable with, should we be investing at this time? And for me, the answer is yes, but it's even more important that you are investing with seasoned operators that, can deal with a little bit of adversity and navigate kind of uncertain or choppy waters.
Yeah.
Because, that's where we are and that's what's ahead in the near term, at least.
So just for fun and curiosity, any particularly interesting investments as a limited partner, anything way out there, way outside of the sort of multifamily that you invest in?
Yeah, so I not way out, but a couple things I'd point to. So I'm invested in 317 hotel keys here in Atlanta, across 3 Fairfield Inn and Suites by Marriott. So that was kind of outside of my thesis, if you will. But it also enabled me to diversify, where I was investing from a passive standpoint. Now, as you might know, hotels took a beating during COVID. The hotels that I'm invested in probably went down to a skeletal crew, 15% of what it was pre-COVID. And so at a macro level, the hospitality industry, the hotel folks that I follow and listen to have said that we will not return to 2019 RevPAR or revenue per available room numbers until late 23, maybe 24. Now, depending hotel, it's always, real estate is location, location, location. If you're in a hot area, if you're in a Miami and you're catering to tourists, you're probably going to be fine. But if you're catering to a business clientele, we know that business has not returned to normal, and what was normal may never be again in terms of business travel and return to office and all of those things. But we know hospitality has been hit. So that's kind of one investment that was off the beaten path that I've done. I've also invested in a ground up development of micro units in San Francisco, which is nearing completion right now. It was a project that was fast tracked by the mayor of San Francisco. And I laugh when I say fast tracked because fast track just meant that instead of maybe it taking us 4 years or 5 years, it took 2 or 3 when it didn't need to. But that'll take me in a whole nother direction if I go too deep into that. But what I liked about that investment is that these are micro units. I think the average square footage is about 388 square feet. They have common areas that are shared. And they're really targeting working class. Now, working class for San Francisco, you can be making 6 figures and be considered working class. And it's the first kind of privately developed development of its kind in San Francisco. And that's why I was able to get some political support.
Good. Yeah, exciting.
Affordability and housing shortage is particularly acute in San Francisco, and that's the other side of the Silicon Valley story. That folks are familiar with. If you are a teacher, a firefighter, a police officer, trying to live within San Francisco is next to impossible. So that's another thing that I invested in that's kind of off the beat.
Excellent. So love to take a step back and just say, I think being a limited partner or being a co-GP, for example, 2 great ways to take a couple steps outside of your wheelhouse in a relatively safe way. I love how you're investing in hotels and smaller units. That's something that just fascinates me. We do have a major housing crisis. This is one of the reasons why I'm in the building industry. We need people to jump in. And the last generation of builders, I think they've still got their tail between their legs. It's going to take a new generation of builders to get us out of this. And I know all the developers must be laughing when you say fast tracked, because it can be crazy just how many monkey wrenches get thrown in the works over a development project. Definitely not for the faint of heart. So great stuff, and just love to see people getting outside of what I would call the sort of maybe straight down the middle multifamily business. I like to call multifamily the gateway drug. If you want to get into commercial real estate, clearly this is the easiest place to do it. And I just love to see people taking those next steps, because this is a very crowded field. I think we definitely have to look for those deals a little further on the outside edge. And that's something that's definitely impacted my thesis. Definitely, I'm looking a little outside. So, wow. I mean, I know that we can't just go on forever. I wish we had more time. So let me just see where we can go from here. I know that obviously you are now a full-time real estate investor. Have you got any tips for people who are maybe in their W-2 right now and looking to make that transition to full-time?
Absolutely. So this is a conversation I have quite a bit when folks reach out to me to kind of hear more about my story and kind of how I made the transition. So in giving that advice, I think about what might I have done differently that would have better set me up for the transition that I ultimately made at the end of 16, beginning of 17. And so the one bit of advice I would give to anyone who's thinking about making this transition is you can do it in a much more of a smooth way than I did. I say that I kind of did it cold turkey, if you will, and then kind of figured it out as I went. I should have been investing in my education about this space well before I left. And one of the reasons really that I left corporate life was because I knew as long as I was well compensated, but the demands on my time were real. And so I knew that I would always have an excuse as to why I couldn't get to that multifamily conference, why I couldn't go tour that property, why I couldn't meet that broker. Because I'm in Brussels 4 or 5 times a year, Sao Paulo 4 or 5 times a year, Mexico City. All of these things were demands on my time that were legitimate reasons as to why it would be challenging to try and do some of the things that you need to do. Networking is essential. Relationship building in this space is essential. And when you have a full-time demanding corporate job, it becomes very challenging to do that. But there are some things that you can do. So I could have been investing passively. One of my biggest pieces of education, when I first left corporate life, I moved my legacy 401k retirement funds into a self-directed IRA and started dispatching that, investing that into various deals. Beyond kind of the ROI that was expected with each one of those investments, I kind of mine those for free education. So, these are institutional quality deals of the type that, I aspire to do, 12, 18, 24 months down the line. But I said, let me see what the sophisticated institutional investors do and how they do it. So, what does the capital stack look like? What kind of debt? What's the exit strategy? What does investor relations look like? All of those things that you get insight into as a passive are going to serve you well when ultimately you make that transition. So again, simply investing passively would have made for a smoother transition when I ultimately decided to transition. And so I would share that advice with anyone. The other thing that I would say, the last thing I would say is at some point, all roads lead to capital being raised. So if you aspire to do this, at some point in the future, you are going to need to raise capital. And that process should not start when you need money. That process should start now, if not yesterday. Right. And so what I mean by that is if you've been investing passively, or if you have a passion or interest in real estate, you need to be engaging via social media and sharing that passion, that interest. If you've attended a conference, that's something you should be posting about, sharing about. if you listen to a great podcast episode, you should be sharing that, sharing the insights that you glean from that episode. In short, you should be sharing your real estate investing journey with everyone within your network. And the best way, the most efficient way to do that is by leveraging social media. So I told people I was a podcast guest on maybe 5 or 6 podcasts before I ever did a deal. And I wasn't portraying myself as an expert, but what I am an expert in is telling my story, my real estate investing journey, the transition from corporate to real estate and entrepreneurship. I could share that story, and that story resonated with a lot of people who were in corporate life and didn't necessarily see a way out for themselves. So start now, not when you need money. That would be the other piece.
Great. And before we leave the W-2, you're somebody who's built teams in the past, not just in real estate. So I'd like it if you could tell us, what is the greatest lesson in leadership you've learned along the way?
Yeah, so for me, the greatest lesson would be always try to be the dumbest person in the room. And what I mean by that is when you're hiring and assembling talent and building teams, you want to attract and retain really bright, intelligent, curious people, and surround yourself with those people, because once you do that, you are able to get out of their way. And your job as a leader is to get out of their way. So you have structure in place, you have infrastructure that they can use to navigate to reach their destination, their objectives. But to the extent that you aren't assembling and surrounding yourself with exceptional people, you are going to be more inclined, if that's your inclination, you're going to be more inclined to micromanage. And so over the 20 plus years of corporate life, and the experience that I have in building teams, I would go for someone who had less specific knowledge, industry knowledge. I would opt for someone who, in my mind, or in my opinion, in my view, had a higher potential or higher upside and a greater kind of propensity to learn, which starts with curiosity. So sometimes people will put together a job description and it's so specific, and they're telling HR that no, this person doesn't work for this reason. They don't check these 9 of 10 boxes, and this person doesn't, they didn't have 5 years of this and whatever. And sometimes you end up losing out on real talent that could come in, and if given the opportunity, really perform at a high level and take your team and your organization to a higher level. So surround yourself with people who are brighter than you, and try and be the dumbest person in the room.
Love it. Yes. I know a lot of people who do try to hire more towards the talent and aptitude versus I've already done the job and this is a safe hire. And certainly, I think that has produced a lot of exciting results in the world. I think a lot of perhaps our greatest leaders, I think people like Steve Jobs, of course, I think he also did kind of micromanage people a little bit maybe, but, I think he would agree with that. Just, you got to hire the best people and, just let it take off.
Yeah.
All right. Go ahead, please.
You feel very comfortable delegating when you have, again, you're surrounded by talent. It's Good. When you have questionable talent, that's when you as a leader to end up doing things that perhaps really at that stage of your career you have no business doing.
Yeah. Awesome. Well, I wish we had time to go a little further, but I did want to hit this lightning round. Are you ready to head into the lightning round, Clive?
I'm not sure what I'm heading into, but I'm
okay. Good. So and that's good, because this is the truth. I didn't give these questions out ahead of time. This is going to be 100% extemporaneous. So, all right, let's go back to the real estate markets. Tell us something about one of your real estate markets that most people wouldn't know.
Yeah, so I'm almost exclusively focused on the Atlanta metro. So the thing that I would say about Atlanta, if you look at, you talk to anyone, everyone's list is a little bit different. But invariably, if you ask people, what are the top 3 to 5 multifamily markets, Atlanta's always going to be in the top 3. depending on who you're speaking to. But what people don't know is that this isn't kind of we had a good 2021 or we had a good 2019 or 18. For the last 11 years, Atlanta has really traded places with the DFW market in terms of number of units that have been acquired and changed hands. And so, again, Atlanta has been Atlanta has been a hot multifamily market, not just for 1 or 2 years, but for more than a decade. And, that continues today in terms of the net migration that Atlanta is benefiting from, like much of the other parts of the Sun Belt. But again, not everyone necessarily knows that, and not necessarily knows the number of units that are changing hands. And it's either number 1 or number 2, depending on what year we're talking about.
Yeah, exciting. Definitely, there's a difference between the size of a market in terms of population and the amount of multifamily stock. So that is a great and exciting fact. Love Atlanta.
We do too.
What is some advice you would give your younger self?
Basically, be more courageous, take risk. I wish that I had not been as safe and precautious in navigating my career. And kind of the getting outside of my comfort zone, which, 2000, at the end of 16, beginning of 17, it was all about getting out of my comfort zone and leaving behind a world that I had become very familiar with and perhaps even complacent in. So I would say, 1, you're going to grow exponentially to the extent that you stretch and challenge yourself. Mm-hmm. And really, that's got to come from inside you and really be self-directed.
What is the best advice you've received in real estate, or what advice would you like to give our audience today?
Whatever it is that you're trying to accomplish in real estate, this is true beyond the world of real estate, but whatever it is that you're trying to accomplish in real estate, surround yourself with people who have already achieved what it is that you hope to achieve.
Beautiful. And I see that real estate is a place that I feel there's a lot of dodgy advice going around too. So what's the worst advice you've ever received?
Yeah, so it's not necessarily advice that I've received, but one thing that I've heard that I think is somewhat irresponsible is you get a good deal and capital will find you. Yeah, I've heard that a number of times. And I understand the context of the comment. But I think it's somewhat irresponsible, especially when you're talking to people who are earlier in their journey, who think, if I find a good deal, I'm going to get it funded. And It doesn't work like that. And so I think it's somewhat irresponsible unless you surround that advice or that commentary with a little bit more substance as to what you mean. And I think without that substance, it can be misleading.
Great. Thank you for calling that out, because I'll just say that I think that there's a lot going on the guru front these days. A lot of people just telling you to just jump in, do a deal. It's easy. Stuff that worked in a rising market that may not work now. Yes. And I think that I'm seeing more and more guru advice that sounds more and more self-serving. So
yeah, and what might work for them won't necessarily work for someone who's starting their journey.
Love it.
And I think sometimes, I won't use any names, but you look at kind of notable figures in this space and you say, this is what they're teaching. And sometimes I think as good and as successful as some of those people are, they are not necessarily tailoring and customizing their teaching and their guidance to people who were where they were 15 or 20 years ago.
Wow.
And so I'm not questioning whether or not what they're saying will work, but it might need to be fine-tuned for someone who is beginning their real estate journey. And so that's something I would be mindful of.
Beautiful. Now let's take a nod to the randomness of the universe. I've got a deck of random cards here. Just let me know when to quit cutting and we'll take it off the top.
Cut it in the middle. Let's go.
All right, we're going to cut in the middle and then we're going to stop. Okay. And if you knew that you were going to inherit a fortune, how would your plans for the future change?
If I knew, I would, I'm really big on impact. And so I think the world of impact investing would be something that I would be quickly navigating into. I see a lot of kind of societal issues that I feel somewhat helpless in terms of making a real impact. Homelessness, just to pick one. And so I'd like to think that I would be exploring innovative approaches to addressing the housing issue and specifically homelessness. And so, if I knew that I had that that fund that was coming my way, I would be thinking about how can I divert some of those funds into issues that are important to me and really have the potential to impact society well beyond me and my family.
Excellent. Name a book that's helped to forge you as a leader and as an entrepreneur, and why?
Leader and entrepreneur. I would say there's a couple books. So Michael Blank's Financial Freedom book was impactful to me early on in my pursuit of large-scale multifamily. I love the fact that he shares his story of failure in the restaurant business after having kind of exited, been a part of an IPO, cashed out, made good money, and rolled that into the restaurant industry, had a huge failure in that space before again pivoting. And so that one was influential as I kind of started exploring this terrain. Another book for me that has nothing to do with real estate, but I think it's 100% about leadership. It was actually a book authored by a classmate of mine from undergrad. And that book is The Power of Dignity. And that's by Judge, I call her Vicky, Judge Victoria Pratt. And it really gets into how we could potentially transform the justice system and how we do and mete out justice in society. And so I think she's been an excellent example of leadership, and in a very stodgy, traditional space where innovation really isn't welcomed. She's tried to be a leader in terms of transforming at least the areas that she's had her fingerprints on as a judge. So nothing to do with real estate, but a great read, great story, and a phenomenal individual and leader.
Excellent. Well, that Michael Blank quote sets us up as a perfect segue for the next question. How has a failure or misstep set you up for future success?
I would think of something, this may be a little bit bizarre, but when I was 11, I want to say 10 or 11 years old, at the end of the school term, we were given an assignment. So we were given a yogurt container with a plant in it. And we were told, take this home. And then, when we return to school, bring it back and we're going to kind of, see how well it's blossomed and what have you. And so I took it home. I would water it, and I was impressed by the growth of the plant. And I recall the first day of school, all of these kids, probably 11 and 12-year-old kids, brought back their plant, and I thought I was the man because my plant had grown pretty well. And I walked into class, and mine was probably the smallest in terms of height, had the least amount of growth. I still had it in the same yogurt container because I didn't realize that I had to repot it into a proper container. And so everyone, their mom or their parent or someone had told them, given them guidance as to what they needed to do in terms of putting it in light, watering it, repotting it, all of this. And so the lesson from that I took away early that has stayed with me many years later is, however hard or whatever efforts you're putting in, you can never assume that that's going to be good enough or sufficient enough to get something done. There's always someone out there who's watering their plant more, who's put it in a bigger pot, who's put it in brighter light, is nurturing it, talking to the plant. You get the analogy. And so that told me early on that you've got to be self-driven, and your efforts, as good as they may end up not being good enough when compared to a broader sample. And so as an 11-year-old, I never forgot that story because I walked into there thinking, oh, I'm the man. And left there like, man, my plant was like the puniest little plant. So that would be a lesson, a little off the beaten path, but that's what I would offer.
Awesome story. Now, can you send us out with a favorite quote?
A favorite quote. I'm going to butcher it, but it's a quote by Chinua Achebe. He's actually a deceased Nigerian author, a novelist. But he has a quote that says something to the effect of, I'm going to paraphrase it, that until the lion is telling its own story, the hunter will always be glorified. And it's basically, the takeaway is that unless the lion is able to tell its own story, the hunter is going to tell the story from his or her perspective. And in that telling of the story, the hunter is always going to be glorified. And so it really speaks to the importance of telling your own story and not allowing others to tell your story for you.
Excellent. And for people who want to reach out to you and hear more about that story, how can we find you?
Yes, I recently launched my website, so that is the best way to get a hold of me, and that's parkroyalcapital.com. And if you go there, there are all kinds of ways that you can get a hold of me. I'm on social media. I'm on LinkedIn. I'm on Instagram. I'm on Facebook. But basically, if you go to my website, there's ways to contact me. If you want to talk, there's a way to book a call with me. I love talking about real estate, and so I invite that, and I challenge your audience to reach out and engage with me further.
Excellent. Thank you so much for taking the time to come and speak to our audience today, Clive.
Thank you so much, George. I appreciate it. Thanks for giving me the opportunity to share my story.